It's very simple. I mean, what would the logic say? The logic would say the powers that be, and this is coming from a country that's the second largest producer of silver in the world. People missed what they said in November. Everyone's focusing and fixating on the fact that they said we're going to limit exports because we're the largest exporter, or in essence, the largest refiner of doré. It snaps back into real price discovery fast, where the speculation is out and you know, at least largely out, and it seems to be moving in that direction. We will see real price discovery. Not yet, but these folks will play the long game until the people here are no longer stupid enough to send the metal at that premium. There's definitely state players within the exchange, just like there is now on Comex, where who the hell's standing for delivery for billions and billions and billions every month?
Right.
With no one asking that question, but it seems to be me. Yeah, I owe the original design to Keith Neumeier. Keith sent me, and Keith is the one who called it years ago. He sent me a shirt 3-4 years ago over the holidays, and I liked it so much I had to make some of my own. But Keith is the one who called out triple-digit silver. I give him credit. And I sent him an email when it hit $100 and said, you know, those shirts are now collector's items, and way to go for having the nerve and the courage to say it. And we'll be back there again, don't worry. You can see that by what's going on. I also, real quick, I wanted to say one thing, if you don't mind. When I was on your show the last time, we had talked about something, or you and I talked offline, and I've done a lot of research on it, and I want to comment about one thing, and that's the premium in Shanghai. With the $10 premium above the Western price, people commented and said, well, what about the VAT tax that offsets it? It's not true. So the VAT tax that is added in China is the responsibility of the recipient of the metal after said recipient takes the metal off of the Shanghai exchange. So think about that for one moment. That $10 premium right now, or thereabouts, that they're paying over the Western prices, arbitrage that is sucking all the silver over, where a sophisticated trader sends $20 million at a $10 premium, makes $200 million and buys yachts in Tahiti. That VAT tax is in addition to a cost for the recipient. In addition to that $10, 13-14% they're paying above and beyond when the metal leaves the Shanghai exchange. It is not the responsibility of me, the sender. It is me, the recipient, when I pull that metal off the exchange. So just a little point of clarity. I promised everyone I would make sure about that, and I am sure about that now. So that VAT tax, in essence, saying to China, is saying, we want your silver so bad, not only will we pay you a premium to the Western price to siphon it and arbitrage it over, which isn't ending, right? Normally arbitrages end right away, because the metal or the money or the investment goes to where the arbitrage is and it balances out. Here it's not. They're saying leave it on, and you'll be responsible for the VAT tax when you move it out of the exchange. That goes to show what the real price is and how badly they want it, and you know, just how screwy the Western paper price is. So just a little point of clarity.
One of the clearest signals comes from Asia. On the Shanghai Futures Exchange, silver has been trading at a persistent premium above Western prices, sometimes by as much as $10 per ounce, excluding value-added taxes. In normal markets, arbitrage closes such gaps quickly. This one hasn't. That suggests strategic buying, not speculation. China, already one of the world's largest producers and refiners, appears willing to pay above market prices to secure supply. The implication is profound. Price discovery may be shifting eastward. If physical demand overrides paper pricing, Western exchanges could lose control of the narrative.
It's very simple. I mean, what would the logic say? The logic would say the powers that be, and this is coming from a country that's the second largest producer of silver in the world. People missed what they said in November. Everyone's focusing and fixating on the fact that they said we're going to limit exports because we're the largest exporter, or in essence, the largest refiner of doré. Doré are the bars that are crudely refined, that are pulled out of the ground by the miners, but China is responsible for refining the majority of all that doré bar across the globe, and then much of that would flow back into the Western markets. That's important, but what people missed is a couple months before that. Now, they said that, by the way, in response to the United States classifying silver critical. But In November, they said, by the way, we're the second largest producer of silver in the world, and all the metal that we mine domestically will be held for domestic consumption. So you're talking
the export ban we heard about, right?
So, but that was in January. November, we're going to keep all the metal we mine. The export ban had more to do, in my mind, with the refining of doré bars, and because they take so much of it in, and we're just going to slow down what we send back out. But in terms of why, I mean, think about it. What it basically says is we're choking on dollars. This is a byproduct of this huge trade surplus. And we realize that dollars have the lasting power of a melting ice cube. So let's take as many dollars as we can and find ways to find value for those dollars. And if it means paying a premium above the Western price, which we, the Chinese, believe is BS, then let's just pay more for it. Doesn't matter. That's the same mentality they've used for my entire career, Adam, when they have been mining gold that all analysts were saying was non-economical, that it was costing them $600 to pull gold out of the ground when it was priced at $400, $1,000 when it was priced at $700, $2,000 when it was, so they're digging deeper, going further. What do they care? This is the thing that is important to understand. If their plan is where people really fall short, in my mind, and trying to analyze this stuff, is the mentality that we have found ourselves in over the last several years. Now, you and I grew up at a different time, Adam, and a lot of people watching the show will understand what I'm going to say, but we grew up at a time where nothing came easy. There was no free lunches. You worked your ass off. You outworked people. You studied hard. You meritocracy, right? We've entered a period of time of gambling. Growing up, these kids in high school now or in the last 20 years have grown up under, Texas Hold'em, AI stocks, crypto, all of the things that have created instant gratification, right? So, but these people are thinking way long term, as far as I'm concerned, way long term. And that's really what's really important to understand with all of this is a long-term play for them, and they will continue at every turn they can to slowly drain the system, and to use the Western price against us. And I think that's exactly what we're seeing right now, is the Western price that I think price discovery is shifting eastward. It's leaving London, it's leaving New York, and as long as Western paper stays disconnected to Shanghai, physical silver will keep getting pulled out of the West and sent to where it is really valued. And the scary part is even Shanghai is getting tight with premiums moving out. And I think that's why forwards and futures are starting to feel undeliverable, where market makers can't source the metal easy enough, they can't hedge cleanly enough, and their exit becomes the move, where, in other words, the players here in the United States, it looks like they are exiting their positions. And that's where I think it snaps back into real price discovery fast, where the speculation is out and at least largely out, and it seems to be moving in that direction. We will see real price discovery, not yet, but these folks will play the long game until the people here are no longer stupid enough to send the metal at that premium, which won't go away because they're choking on our dollars. They're literally choking on them. So here's value. We don't care if it's more than the Western price. We've been using the Western price against them for years.
Meanwhile, activity on the Comex has reached levels rarely seen before. Delivery requests for both gold and silver contracts have surged, with tens of millions of ounces reportedly leaving vault systems in a matter of weeks. Schectman highlights a key anomaly. More metal has exited vaults than the number of contracts formally standing for delivery. That suggests accumulation beyond standard future settlement. When bullion leaves registered inventories, it is often removed from circulation entirely. Such persistent withdrawals point to institutional, possibly sovereign, players securing physical metal, not merely hedging positions.
Maybe even more than that, Adam, is they're saying, and pardon my French, that they believe the Western price is bullshit. Pardon my French. I just want to get that point across. They're saying the Western price is not right. We know it, they know it, but the public doesn't know it. So let's just quietly exploit that inequity. And arbitrages always end quickly. The world is so awash in instant information, and arbitrage exists at that level, at that kind of volume. It's over like that. The big JP Morgan traders, and boom, it's over. They'll just flood it until it's over. They'll send so much over there to take advantage of arbitrage, it ends. This hasn't ended, and it stays amazingly consistent for months on end. That is strategic. That is them saying, go ahead, be dumb enough to continue to send us this. And it fits hand in glove. Look at their policies for the last 20 years, building the Belt Road. What is the Belt Road? The largest infrastructure project in human history, consisting of countries that are massively resource rich, but maybe underdeveloped. Look at the countries that joined the BRICS. These are all countries that are resource rich and have strategic shipping lanes. Look at everything they are doing. And it all revolves around either accumulation of natural resources, exploitation of Western price to do so. But it's not just in gold and silver. You go across the board on all the commodities. They already have a massive head start on not only production of rare earths, where 90% of the rare earths are accumulated or mined in the Eurasian, continent, but they also refine 90%.
Right,
and that's why Trump came in. Trump came in and said, we're going to build this $7 billion smelter with the help of South Korean company. But these are the realities that, fortunately, someone in this administration understands. And that's why, and we'll talk about the deliveries. And I keep saying it. That's all you guys need to know, period. Nothing else matters. It's all noise. When we get to the deliveries, you'll understand that, in my opinion, it is all that matters. Now, this is a good piece of the puzzle, that the arbitrage, which never lasts this long, and it tells you that it's past the point of being economical for the Chinese. They don't care what it costs. We think the price that you are telling us is real isn't real. So we'll take everything you had and add $10 to it, and we'll pay the VAT tax to the government on the way out of the exchange. That's the real price of silver today. We'll see what tomorrow looks.
Recent volatility has also been shaped by aggressive margin requirement increases from the Chicago Mercantile Exchange. Higher margins force leveraged traders to liquidate positions, triggering sharp price drops. This pattern has occurred before in precious metals bull markets. However, this time may be different. Large institutional buyers standing for delivery are typically unleveraged and unaffected by margin changes. While speculative traders are flushed out, deep-pocketed entities appear to accumulate at discounted prices. The question becomes whether these engineered corrections are temporary resets, or the final attempts to suppress a tightening physical market.
There's definitely state players within the exchange, just like there is now on Comex, where who the hell's standing for delivery for billions and billions and billions every month?
Right.
With no one asking that question, but it seems to be me. And that's money that is far bigger than anyone that you can even think of has. This is state money. This is exchange stabilization, U.S. Treasury money that is standing for delivery for billions every month, as far as I'm concerned. And the same thing would be true there. You have sovereign wealth funds and state players that are buying and on behalf of, or commercial banks buying on proxy for who. So anyways, bottom line is that, yeah, even though it's not completely state run, it's administered, the regulations, by the state and by the government. And I'm sure there are, government actors in there that are opaque, maybe, that are being run by a bank in China on behalf of, one of the things that's interesting when you look at the way China accumulates gold and has for years, they have all these ministries, Ministry of Education, Ministry of Defense, and they all own gold. It's not just the PBOC that is accumulating it. When the People's Liberation Army buys it, or the Ministry of Economics buys it, on behalf of that group, it's not reported to the IMF. Now, ultimately, it's all of that's probably going to flow to a certain point at some point, but it allows them to continue to accumulate stuff all the time with, and by the way, voluntarily is the reporting requirements. There is no real reporting requirements. They voluntarily give that information to the IMF. So they'll 1 out of 10 ounces maybe that the PBOC buys, they'll report to the IMF, but the rest of it, the 9 out of 10 is bought by other agencies within the government that technically, they can feel good about not reporting it. It's just a way to sidestep the reporting requirements.
Okay, and so on that, and then I want to get to the physical side, but I'm imagining you're one of the people that thinks that China's true gold holdings are vastly higher than what they report to the rest of the world.
Massively higher, yes. Alistair McLeod said 40 million ounces a couple of years ago was his guess. 18,000 by the people, 22,000 metric tons by the state, which would be roughly 5 times higher than the United States has. And, my whole career, they never updated they were stuck at 1,200 metric tons forever, yet they mine 300 to 400 metric tons a year. And they're the largest producer of silver on the planet, or gold on the planet. Never increased the numbers ever, and they have been playing with that number forever. So yeah, way more than they tell us.
Since 2022, global central banks have purchased gold at the fastest pace in modern history, signaling distrust in fiat reserves. Nations such as China have steadily expanded official gold holdings while maintaining opacity about total reserves. At the same time, silver has been designated a critical mineral in the United States due to its role in defense, electronics, and renewable energy technologies. Strategic stockpiling, similar to petroleum reserves, is now openly discussed policy. If governments are competing for finite supplies of bullion, private investors may find themselves reacting rather than leading.
Yeah, let's talk about gold first, and then we'll talk about silver. So in terms of gold, right, you have 4 days before February gold has to deliver. Now, much of the February gold has already delivered. Typically, the first day that the contract goes off the board, which would have been the end of last month, January, those who are holding contracts stand for delivery. But there's been a lot of contracts that throughout these months that buy during the delivery month and take immediate delivery. And there have been others that have been hanging on. But with 4 days to go, there's still 4,366 contracts open, or 436,600 ounces of gold, 13.5 tons. Now, that's insanely high, Adam, for this late in the cycle. It's 24 times normal, right? And even bigger than the upcoming March contract, which we'll talk about. But this is a massive red flag. And to me, what it means is that someone is really short and they haven't closed out for weeks. And this typically would be the hallmark of selling gold you don't have. If they were planning to buy it back, they're now trapped because the liquidity this late in the contract is very thin. Everyone's already moved on to March or even to May on the contracts. So with physical gold tight, to me, this is a player who sold gold without having the real thing. And gold works on confidence. The moment the market believes there isn't enough metal, the leverage unwinds, and violently so. So keep that in mind that today, with 4 days left, there is 13.5 tons, right? That could very quickly become a very, very big problem that hasn't been delivered yet. We'll see what happens with 4 days left. But it's even, I think, a little bit crazier than that when we take a look at the tighter, more explosive cousin of gold, silver. And in silver, one contract equals 5,000 ounces. Here's the interesting part about the February contract before we get to March. I don't know that I've ever seen this before. So Comex silver is leaving the vault faster than the February 2026 contract is asking for delivery. What do I mean by that? So far, for the month of February, cumulative deliveries have been 4,639 contracts. That equals 23,195,000 ounces. All right, so those are the deliveries, right? So for February, we saw 23 million ounces of silver delivered so far. However, here's the interesting thing. What does delivery mean? That means there's a paper contract, and you usually, when it comes due, you can cash settle, any money, you can roll it forward to the next delivery month, or you can stand for delivery. So when stand for delivery, there's two categories. This is really important to understand. Inside the Comex walls, right? I have 8 Brinks facilities that we work with. Of the 8 Brinks facilities, 1 is Comex. It's JFK, New York City. In that facility, I have clients with millions of dollars worth of 1,000-ounce bars. They're an eligible category, not for sale, but eligible to be moved to the registered category for sale, right? So when you hear of all these deliveries, delivery could come in and move to eligible. It is no longer for sale. It's held in a Brinks vault or a Delaware depository or CNT. These are all Comex facilities. It's there. It's not for sale. It's eligible. I'm holding it. But the registered are the bars backing. So, okay, great. That doesn't mean that it leaves the facility, right? So let's go back to what I was just saying. There have been 23,195,000 ounces that stood for delivery in the month of February. And there's 4 days left, and then it's over. Then we go to March. Here's the interesting thing. The actual February withdrawals, the metal that left the vault, is 164% higher than the February 2026 delivery. 38,082,934 ounces have left the building. Elvis has left the building. 38 million ounces left, 23 million ounces were delivered. How does that work? They're taking more metal off the exchange than is even being delivered. They're pulling metal out of maybe the eligible category. It's leaving. That metal's never coming back. When you move 38 million ounces by truck out of the Comex warehouses, you think that stuff's ever coming back? Who's taking possession of 38 million ounces? This is what I've been screaming. And this is all that matters. If a 500-ounce mint box weighs 42 pounds, who just took possession and left the warehouse for almost over 38 million ounces? Think about that for a moment, about the logistics that is involved in it. Now, I think it's the Exchange Stabilization Fund. Like I've been saying, for 16 straight months, we've seen these kind of deliveries and withdrawals for 16 straight months. Not one person in the mainstream asking this. All they talk about is the price and the BS fundamentals where they paint negatively. Never do they say, you know, Johnny, forget about all that. I want to know who the hell's standing for delivery. Where's it going? This never happens. This is all that matters. And the lack of journalistic integrity, the one half truth, but missing the whole story. And do you think, Adam, that there's any coincidence that after all of these months of delivery and all of these months of metal being pulled off the exchange, just by coincidence, it's now critical mineral? We're going to call it critical. And we're going to put a state-sponsored price floor under it. And you know what? Just for good measure, we're going to accumulate a strategic stockpile. So all I can simply say to you, now that's February. Let's talk March for one moment.
Okay.
The defining question remains, is this consolidation before another rally or the start of a deeper correction? Schectman argues that sustained physical deliveries, not daily price charts, offer the clearest clue. In 2011, futures speculation drove prices. Today, sovereign entities and central banks are accumulating tangible assets. If supply tightness continues and confidence in paper markets erodes, price discovery could reprice both metals significantly higher. Markets often shift gradually until they don't. Whether this becomes a historic breakout depends on one factor. Will physical demand continue to outpace available supply?
I would say that the legit companies like, let's say, Tesla, they'd leave it in the Brinks vault or move it to, in certain points, to the manufacturing facility where they make the cars and the batteries. But if I'm the Exchange Stabilization Fund, it's going, I don't know, is there a vault under the White House? Who knows? Who knows where? Is there a vault under the Pentagon? Who knows? And that's a fair question. I mean, how?
Well, there just aren't that many places you can store this much silver other than in a professional Brinks vault, or if you're a government, your secret bunker lair. Yeah.
Well, and what's 38 million times 80? What is that? 38 million ounces times 80 in terms of dollar value is what? What would that be? 2 point.
I think it's 2,400, whatever, if you're multiplying 80
Well, let me just, I can't even do
or
the
38
math.
by 80. But yeah, here, I'll do it. You talk. I'll do the math.
38,082,934 times 80, let's just call it. What do you get?
It's roughly 3,000. So if you're at millions, what is
You're
that?
talking billions
You're talking
and billions
three
and billions
billion,
of dollars,
yeah,
right?
yeah.
Okay, so, but we've seen between roughly 40 and 70 million ounces delivered every single month, going all the way back. And so, and a lot of it leaving. And ask yourself, where the hell is it going? Who's taking possession of it? Dollar-wise? Logistics-wise? Oh, but that's right, we just classified it critical. It's just a complete and total coincidence. What can the Exchange Stabilization Fund do? Who are they? Branch of the Treasury. I can do this if I'm the Exchange Stabilization Fund without telling anyone. Why? It's national security. What do we just call silver? A critical mineral for national security. Oh, That makes sense. So in my mind,
this is akin to the Strategic Petroleum Reserve, right? We're creating a strategic silver reserve. We're just not letting the world know that yet.
And you can't. That's exactly right. And because remember, it's tariffs. That's why all the metal came back to begin with. That's what they want you to believe in the mainstream. It's just tariffs. No, it's not tariffs. And the way that this has always worked, just so you know, when you look at Tom Luongo's theory of saying Trump believes that the European, this Tom's theory, and it's interesting. He thinks the European aristocrats were behind the color revolution and the perception of election interference. That's what he believes Trump believes. And when you look at the fact that the banks, so there are 8 Western banks that for 30 years have in collusion suppressed the price of silver. There's 1,000 commodities or so traded on Comex. 8 Western banks forever have maintained the largest concentrated short position of any commodity ever traded, ever, on Comex. Why? For the military-industrial complex. We've covered all that, right? So the way that it would work, I'm a bank in the U.S., you're a bank in Europe. We're buddies. We've been doing this forever. We don't break bread together maybe, but we're tight. We're first name, and we know what we're doing together. You're UBS, and I'm Citi. And I will suppress the price on silver on Comex by dumping paper contracts on Comex. I drop the crap out of it. But in order to offset that on my books, I need to buy a contract from you in London at the exact same amount which could stand for physical delivery. I am balancing my balance sheet, right? But the only place the price is affected is in New York. So by selling in New York, I drive down the price. By buying a contract for physical in London, I'm not. So in going back to the way it used to be, less than 1% stood for delivery. So once in a while, I would call you up and say, listen, man, I got to have some of that metal sent back. There's going to be some settlement. But normally the way it would work would be we would exchange warrants back and forth. I own it, you own it, I own it, you own it. But sometimes metal goes back and forth, exchange for physical. Sometimes they're legitimate deliveries. So this time around, I think Trump said, you tell them all it's tariffs. You tell every one of them the game is over and they're in trouble. Who is left holding the bag? Who is left exposed? According to the article by the Economic Times, it is the European banks and those in Canada that the U.S. has become net long. Now, what does net long means? It just means more long than short. Could it have been that last collapse that we saw was in an effort to get some of these banks on sides, like clean out your shorts because it's going to get very ugly? Maybe. And I kind of feel that it was very much engineered by raising margin limits so high that you had so many forced liquidations. And it's ironic. You'll tell me how ironic this is. So when you talk about the margin limits, if you go back to a couple weeks before Christmas, it might have been $15,000, $16,000 for us to hedge a 5,000 ounce silver contract. We normally have 2 million ounces in our warehouse. So if you can hedge 5,000 ounces for $15,000, if you have several $1 million in a margin account, you can have a $2 million ounce inventory hedged ounce for ounce. But then they moved it up to 18,000 right before Christmas, 21,000 the day after Christmas. Now it's just under 50,000 to hedge 5,000 ounces. If you don't have $50 million in your margin account, good luck. And so not only has it made it very expensive to hedge. This is what has gummed up the refineries. This is what has made it very expensive for companies like mine and even a notch above the primary distributors to hedge, because it's become so expensive to hedge. But when that happened, they did this to flush out the speculation on Comex. If you have 100 contracts and you say, look, silver's going straight up, we can take advantage of this. We can do so by buying a bunch of contracts, right? $15,000 back then would allow you to control, in essence, 5,000 ounces at $60 right around Christmas. That's 300,000 worth of silver. Let's do it. Let's buy 20 contracts. Then they raise margin. Everyone has to sell, or if you don't sell immediately or add more money to your margin account, it gets washed out. They close you out. Selling begets selling, begets selling, begets selling, and all of a sudden the price gets clobbered to the largest drop ever, right?